Hey everyone! As a result of the current pandemic, the Bank of England has cut their interest rate twice over the last couple of weeks to help stimulate the UK economy. The Bank of England have also extended their quantitative easing programme and announced a new term funding scheme for small businesses. In this video, we will cover why the Bank of England cut their interest rates, what quantitative easing is and how it works, and how all of these measures affect UK consumers like you and me. I will also discuss my thoughts on as to all these measures might fuel inflation or even hyperinflation in the long term. So, let's get into it. On the 11th of March, the Bank of England cut their interest rate for the first time since August 2016, and they cut it by 50 basis points from 0.75% to 0.25%. They also announced a new term funding scheme for small businesses. Last week, the Bank of England cut their rates even further to 0.1%, which is the lowest rate in history. They also extended their quantitative easing programme by £200 billion and prolonged their new term funding scheme. All of these measures are aimed at stimulating the UK economy. To understand exactly how these work, let's look at each of them in more detail. The Bank of England base rate is the interest rate the Bank of England pays to commercial banks on reserves that they hold at the central bank. It is also the interest rate charged to commercial banks like Lloyds or Barclays for secured overnight lending. In turn, this interest rate influences the rate that commercial banks will charge borrowers and what they pay to savers in savings accounts. At times like these, when the interest rate approaches 0%, it means that it will become much cheaper to borrow and rates on mortgages and personal loans are likely to go down. At the same time, savings rates are likely to drop because banks can't afford to pay high savings rates to customers because they themselves are only going to benefit from a much lower interest rate on the reserves that they hold at the central bank. The aim here is to incentivize people to borrow money from the bank and businesses to borrow money and invest into the economy. It disincentivizes savers because they're going to get much lower rates on the savings at the bank. The Bank of England has also announced an additional new round of quantitative easing with £200 billion. Quantitative easing is another tool that the Bank of England can use to inject liquidity into the economy. This works by creating new digital money that can be used to buy government bonds or corporate debt. Suppose, for example, the Bank of England buys £1 billion worth of government bonds of a pension fund. This means the pension fund now has £1 billion that it can use somewhere else and invest into the economy. Lastly, the new term funding scheme is also incentivized at stimulating the economy by making more liquidity and loans available to small and medium-sized enterprises. So how do these measures impact you and me as everyday consumers? We've already briefly touched on this, but the main way is through cheaper borrowing rates. Mortgages and personal loan rates are likely to drop in the future. For consumers who are on tracker mortgages, these are directly linked to the Bank of England base rate, and the rates here have already fallen in line with the two rate reductions. Savings rates will also go down in the future, as mentioned before. Lastly, products like credit cards will remain largely unaffected. So, are all these measures going to lead to inflation or even hyperinflation in the long term? Inflation happens when central banks print a lot of money, increasing the money supply in circulation and rendering money essentially worthless. This is what happened in Zimbabwe and Venezuela, and why when you look at newspapers from when it happened back in the day, you can see photos of people going to the supermarket and the grocery store with wheelbarrows worth of cash because cash essentially became worthless. Let me tell you why I think that this is not likely to happen due to quantitative easing. This is because the majority of the money that is created now is only created digitally as digital money, and only the smallest proportion will actually make it out into the real economy. At the same time, because consumers and businesses are so uncertain at the moment, they're hoarding money and reducing spending, so the increased money supply through the central bank is actually making up for a reduction from consumers and businesses. If on the flip side the central bank had announced quantitative easing in a booming time, that will almost certainly lead to inflation and perhaps even hyperinflation. If we look at what happened in the financial crisis after 2008, many rounds of quantitative easing were used by many of the central banks to stimulate the economy. Inflation rates thereafter were actually between 1.5 and 2%, which is exactly what the central banks target for sustainable economic growth. Therefore, I do not think that there's a risk of inflation in the long term. So there we have it. I hope this video was helpful in explaining all the measures that the Bank of England has been taking to help stimulate the economy during this downturn. If you have any questions, please leave them in the comment section down below. And if you learned something new today, Please like, share, and subscribe for more content. Thanks, and I'll see you here next time at Fix My Finance.